This is Nightly Business Report with Sue Herrera and Bill Griffin.
What a week. Stocks cap a volatile and nerve-wracking stretch with big gains. Now investors want to know what happens next. Raise the roof. Mortgage rates are low. Builders should be ecstatic. But it's not working out that way for the housing market. Roadshow. It's a big weekend for classic cars, and the auction block is about to hit top speed. Those stories and much more tonight on Nightly Business Report for Friday, August 16th. Good evening, everyone, and welcome. Bill has the evening off. Take a deep breath. The weekend is here, and the stomach-turning week is finally over. The good news for long-term investors is that it finished with gains. Wall Street was upbeat and the bond market calm, unlike the prior days, which were wild. On Monday, stocks dropped 380 points as investors feared an escalation of the trade war. On Tuesday, stocks popped about the same amount on a delay of some of those tariffs. But Wednesday, the Dow fell 800 points, its worst decline of the year. Thursday, stocks bounced, and today, the bulls came back. The Dow rallied 306 points to 25,886. The Nasdaq was up 129, and the S&P 500 added 41. But today's gains were not enough to lift the major averages for the week. Dominic Chu explains what was behind today's rise.
Stocks staged a rebound today, and it was a confluence of events pushing the markets higher, including talks of more economic stimulus, upbeat comments from top bankers, and possible hopes for trade talks to continue. The stock market has been taking its cues from the bond market all week, and today global bond yields bounced back on reports that Germany plans to put into place a stimulus plan in the event of a recession. That moved German bond yields off their lows, which in turn lifted U.S. yields off their lows. We also had upbeat comments from Bank of America CEO Brian Moynihan adding to the optimism. Moynihan said he sees no underlying signals of recession. Consumer spending is still going strong compared to 2018, and that the situation in Hong Kong is serious but does not pose a big threat as a financial center to Hong Kong. Add to that investor optimism over trade talks. There's no question it's been a wild week and a wild month for stock market investors. In fact, the average Dow trading range so far in August has been 473 points, but the biggest headlines dominating the market's attention continue to be tariff talks and global interest rate policy, and that will continue. For Nightly Business Report, I'm Dominic Chu at the New York Stock Exchange.
So what happens next, and should investors expect more volatility in the days and weeks ahead? Joining us now is Kenny Pocari. He's managing principal at Butcher Joseph Asset Management. Good to see you, Kenny.
And always a pleasure to see you.
And what a week. But you say investors should not panic.
Right. And so we have this conversation every time the market seems to go through one of these hissy fits, right? So the last thing that a long-term investor should do is make an emotional decision. And typically you make an emotional decision when you see days like we've had, which is exactly the wrong time to do it. Take a step back, see what's going on, listen to the conversation, understand whether or not fundamentally the story has really changed or whether or not these are just issues that, we've continued to talk about. And in fact, they're really just issues we've continued to talk about. There's nothing new that happened this week other than that small inversion of the yield curve on whatever day it was, Wednesday, which created this panic in the algorithms, right? Which created that big sell-off. Right. But for the most part, a long-term investor should do just that. They should look at their portfolio. They should see the names they like. They should take advantage of some of the price dislocations in some of those great names that they have.
And you made the point to me earlier that you think this volatility is going to continue well into the fall.
Well, I think it's August and September tend to be volatile months just because of the time of year and what happens. Next week we've got, there's not a whole lot of data that's coming out next week, but there is Jackson Hole, which is that big, Fed meeting at Jackson Hole. So they'll be talking about broad policy statements, broad monetary policy. And then you move into September and you start to have, that fall kind of nervousness as mutual funds start to rebalance, as they start to get ready for year end. And so you tend to have some volatility around that. That being said, don't get frightened by the volatility, but you should take, as a long-term investor, you should take advantage of the opportunities it creates. And
you also made the point that President Xi has a big event coming up. It is the founding of the People's Democratic Republic.
Right.
And that comes in October.
Right.
And you don't think there will be much progress on trade, which has been a driving factor in the market.
That's right, and will continue to be a driving factor in the market. But the reason I think that is because President Xi does not want to appear to be forced at this time in not only their history, but kind of what's going on in that country, to make a deal or to come to the table, or appear to have been forced to come to the table to make a deal. So with the United States. So therefore, I think they're going to work, kind of diligently at just pushing it off. They're going to have a meeting in September. That was part of the reason the market rallied again today, because they talked about that meeting being on. But in reality, I don't think you're going to see much of a deal until we get into November, December.
All right, so fasten the seatbelts. Thanks, Kenny. As always, Kenny Pocari. All right, we learned today that President Trump reached out to CEOs of some of Wall Street's biggest banks earlier in the week as the market started to fall, and he asked them for their thoughts on the economy and trade, one of the driving forces, as you know, behind the market's big swings. Kayla Tausche is in Washington tonight.
As the Dow dropped hundreds of points Wednesday, executives of 3 top U.S. banks found themselves on the phone with President Trump in an impromptu 20-minute conversation that followed a previously scheduled regulatory meeting. They discussed the economy, the Fed, and trade. CEOs told the president they agreed China was a problem, but said the uncertainty was hurting business confidence and investment. He was receptive to that argument, one person familiar with the call said, but reiterated he likes tariffs. After delaying some of those tariffs this week, Trump acknowledged for the first time that consumers could end up paying.
The tariffs have really bitten into China. They haven't bitten into us at all, except for the reporters that want to make it look that way, but they don't understand what's happening. The tariffs, we've taken in close to $60 billion in tariff money, and the consumer has not paid for them. Now, at some point, they may have to pay something.
Tensions with China remain high as it conducts military exercises on the Hong Kong border and slams U.S. arms sales to Taiwan. President Trump says he has a phone call scheduled with China's President Xi, and in the past, it's been those one-on-one negotiations that have improved relations. For Nightly Business Report, I'm Kayla Tausche in Washington.
A new report on housing shows that home building fell for a third straight month. Housing starts for July dropped 4%, but a rise in permits offered a glimmer of hope for the market, since they are considered an indicator of what's to come. Diana Olick has more on the mixed signals being sent.
Home builders should be ecstatic. Mortgage rates are near 3-year lows and just keep falling. The average rate on the 30-year fixed was over 5% last fall. Now it's heading toward 3.5%. While builders say they are seeing more demand, single-family housing starts aren't exactly soaring. They rose just 2% annually in July. Usually starts rise as rates fall, but that has not been the case. The two fell together for much of this year, only diverging in the last few months. KB Home CEO Jeff Metzger said, "I've always maintained over the years that consumer confidence means more than rates to the home buying decision."
This is my house.
Consumer confidence in housing hit a record high in July, according to a monthly Fannie Mae survey. But overall consumer confidence fell in August, according to the University of Michigan survey, which noted consumers concluded, following the Fed's lead, that they may need to adopt a precautionary spending outlook in anticipation of a potential recession. Still, others think the rate drop will make for a much stronger fall housing market.
For every 25 basis point decline in the mortgage rate, that's equivalent to about a 3% price in the home, cut in the price of the home. So right now, home prices are down for the consumer more than 10%. So it makes it much more affordable. And I think today the housing market is responding to that lower rate. We're seeing very good activity, especially at the low end of the market.
But the low end of the market is where supply is leanest. Prices are rising fastest, and buyers have the least wiggle room in their wallets. If the economy falters, those buyers will likely pull back first. For Nightly Business Report, I'm Diana Olick in Washington.
Housing's mixed picture isn't the only part of the economy that doesn't make much sense these days. As Steve Leisman reports, there are a number of economic conundrums that investors are trying to navigate.
If you're not confused about the economic outlook in the U.S., it's because you may not be paying attention. Fed officials, investors, and forecasters are trying to divine the future course of the U.S. economy, battling through numerous crosscurrents. There's weak global growth, but U.S. economic growth is still around 2%. There's rapidly falling bond yields that suggest a recession may be coming in the months ahead, but U.S. economic data that's stayed pretty strong. Finally, there's robust consumer spending, but a manufacturing sector that may already be in recession. Even the titans of Wall Street disagree. Here's what trillion-dollar fund manager Ray Dalio said about the outlook.
Recessions are always inevitable. The only question is when. And I think that
do you see one coming?
Yeah, I think that in the next 2 years, let's say prior to the next election, there's probably a 40% chance of a recession. And I think that you're seeing this around the world.
Not so, says David Rubenstein, founder of the private equity giant, the Carlyle Group.
The U.S. economy is actually in pretty good shape. We're not an island, though, and there's no doubt that as economies in Europe and Asia slow down and go into recession, we can't completely avoid that. But at the moment, I don't see a recession in the imminent future.
Even today, the data sent out mixed signals. Consumer confidence plunged to the lowest level of the year, but that was due to a small drop in Americans' perception of the current situation and a big drop in what's expected for the future. Fed Chairman Jerome Powell said he takes market signals seriously when figuring out where to set interest rates, and he'll probably be cutting them in the coming months. But in figuring out how much, he'll be navigating the cross-currents of very low global bond yields and the dangers of a trade war against economic data showing strong consumer spending, low unemployment, and decent U.S. growth. Rough and confusing waters in which to pilot a ship as large as the U.S. economy. For Nightly Business Report, I'm Steve Leisman.
It is time to take a look at some of today's upgrades and downgrades. TJX, the parent company of TJ Maxx, Marshalls, and HomeGoods, was upgraded to buy from hold at Loop Capital. The analyst cites the retailer's market share gains at the expense of department and specialty stores. The price target is $60. The stock rose more than 2% to $51.39. Brinker, the parent company of Chili's and other casual dining restaurants, was upgraded to overweight from equal weight at Stevens. The analyst says it expects the company's same-store sales growth of 2% to hold. The price target is $45. The stock rose more than 3.5% to $38.46. Merck was initiated with an outperform rating in new coverage over at Leerink. The analyst cites the potential for expanded uses for its cancer drug Keytruda. The price target is $103. The shares gained nearly 2% to $85.06. Still ahead, why the presidential candidates are getting an early start talking about your money. The CEO of Hong Kong's flagship airline has resigned. The head of Cathay Pacific stepped down amid this week's protests at the main airport, which is one of the world's busiest. The airline stock fell sharply, and it came under pressure from Chinese authorities to rein in employees. They were supporting pro-democracy protesters. Today, the protests were peaceful, but concerns remain among the business and investment community. Here's Brian Sullivan.
This political unrest, if you want to call it that, over the last couple of months, and more rallies are expected this weekend, has disrupted the U.S. financial markets. We have seen our markets on edge, and we have seen some of the Asian markets decline, except for the last couple of days. We have spoken with numerous members of the financial markets here, and we've said, will scenes like this dissuade investors, CEOs, company heads, or even public offerings from happening in what is arguably the financial center of Asia? One investment banker told us today that despite protests, one thing the Hong Kong market has going for it is a history of relative company stability.
It's had very few failures of major listed Chinese companies here, which means the due diligence that's done in Hong Kong is done with understanding of how China operates. Whereas UK, the US in particular, Singapore, and even Frankfurt is littered with failed Chinese IPOs.
Now, of course, that stability, which has taken place over years and even decades, may come into question if we continue to see scenes like this, peaceful as they are, and companies, executives, and workers decide there may be better places for their capital, for their companies, and even for their families. Reporting from Hong Kong for Nightly Business Report, Brian Sullivan.
We're still more than a year from the next presidential election, but already candidates are talking about your money.
See, the bottom line is, I know you like me, and this room is a love fest, I know that, but you have no choice but to vote for me because your 401ks, down the tubes, everything's gonna be down the tubes. So whether you love me or hate me, you gotta vote for me.
And the president isn't the only one taking aim at your pocketbook. Democrats are as well. So let's turn now to John Harwood in Washington. John, good to see you.
Hey, Sue.
You know, given the week we just had, a lot of people are wondering how strong the U.S. economy is, and has it changed the 2020 campaign for the president?
I think it's begun to change it, Sue. And, you know, that was an unusual statement from the president after a week of stock market volatility to cast himself as the protector of people's 401ks. But really, the campaign so far has been mostly fought out on cultural grounds. Who's an American? The whole questions of identity, immigration, white voters feeling apprehensive and immigrants feeling under siege. Now this is shifting to more toward an economic terrain because all of a sudden, for the first time in a long time, people are feeling a little bit more vulnerable, and that's going to change this dialogue going forward.
And will the president's campaign be able to adjust to that?
Well, they're going to have to. The president has been more comfortable discussing cultural issues and trying to rouse his blue-collar base with those cultural messages. But he's got a different problem on his hands that he hasn't been used to so far. So far, the culture wars have alienated some voters who are happy with the economy. Now the president's got to worry about that happening in reverse. That is, people who like his messages about immigration, for example, but all of a sudden have a new sense of vulnerability on the economy. The president's been pretty stable in the polls, but does that drive some people away from him? They've got to figure out how to answer that question.
Now let's turn to the Democratic candidates, and there are many of them, certainly at this point. What do they need to do to take advantage of what's happening in the economy?
Interesting cross current, Sue, on the Democratic side. For Joe Biden, who is the familiar frontrunner, I think the more uneasy people feel, the better it is for him. He's a familiar, stable character, especially for the African-American voters that he is dominating right now, even though there are two African-Americans in the race. It's a challenge, I think, for Elizabeth Warren and Bernie Sanders, who have the most radical economic positions. Do those become more scary to people as they're in this situation? And Kamala Harris, who's probably the candidate below those top three most likely to come up, she hasn't really defined her economic positions fully. Does she go for more safety, as she's done on health care compared to Sanders and Warren, or does she go for the fences? She's going to be sketching out her economic positions in more detail in the coming weeks.
John Harwood in Washington. Thanks, John. Appreciate it. Well, the trade war hits Deere's bottom line, and that's where we begin tonight's market focus. The heavy equipment maker missed earnings and revenue estimates, with the company citing farmers delaying their purchases because of uncertainty with the export market. Deere also lowered its full-year guidance, but the stock still rose nearly 4% to $149.23. Revlon is reportedly reviewing options that may include putting itself up for sale. Bloomberg says the cosmetics company retained advisors from Goldman Sachs to consider strategic alternatives for a potential sale of parts or all of its business. Revlon is going through financial struggles and facing increased competition in the industry. The shares rose more than 9% to $16.77. The FDA approved AbbVie's new drug to treat rheumatoid arthritis with a cost of nearly $60,000 a year. The approval comes as AbbVie faces increased competition for Humira, its blockbuster treatment for that same condition. AbbVie rose more than 2% to $64.43. And Palo Alto Networks executive vice president of worldwide sales is stepping down after spending 3 years with the cybersecurity company. Palo Alto says that a search for his replacement is underway. Shares dropped more than 7% to $199.27. Well, if you look beyond trade and the economic headlines, there are stocks that may be worth owning. And our market monitor says he's found some. Joining us now is Sandy Villery, portfolio manager of the Villery Balanced Fund with about $2 billion under management. Sandy, good to see you. Welcome back.
Thanks for having me back, Sue.
You're looking for opportunity for stocks at more reasonable prices, correct?
That's what I do, exactly, yeah.
Let's start with your first pick, and that is Teleflex. It's a medical device maker. Why do you like it?
Well, I think this is somewhat recession-proof as well. So this is a pure-play medical device company, and founded in about 1943. These guys have a long history. They've got a really exciting product called UroLift of all their products, but this one they just raised the target to where it's going to grow from 30% up to 35%. It's a very untapped market, and there's about 12,000 interventional urologists around, and they're only on 2,200 platforms. So we like this product, and we like this company, and it's one that we would buy in any dips or any volatility in the market.
Now, we're staying in the medical device field. Abiomed is your next pick, and you think you could get about 26% return looking out about 12 months. That would be one reason why you like it, but what's going to drive that return?
Yeah, so Abiomed has a temporary pump called the Impella. When we've interviewed different heart surgeons, they tell us this gives them really a bridge to decision where you can put in this temporary pump and then sort of decide, what exactly to do. And a lot of times, patients are leaving with their native heart without having to do invasive heart surgery. So it's one that has almost no competition with over 350 patents, $500 million in cash and no debt. So we love the balance sheet. We think this is going to be a good one, and it trades at a very cheap 7.5 times enterprise value to EBITDA. So we like this one a lot.
It's also a less expensive heart pump, is it not? It's a value play for the medical industry.
Yeah, that's a great point. This is, roughly speaking, it's about $25,000 when you compare it to more permanent heart pump that's about $100,000. So a very reasonable device, and something that is getting a good reimbursement from the CMS as well.
Let's finish up with ON Semiconductor. Why do you like that one?
So this is not one of the more defensive companies because it's got exposure to, it's a semiconductor company, so it's got exposure to the trade war, et cetera. But it's a very reasonable 9 times earnings. And what people don't realize is it's got incredible exposure to the 5G build out that's going to be occurring over the next 3 to 5 years. And I think it's going to be a big deal. Also on iPhones, as well as electric vehicles, they're getting more and more dollars of content on these devices and electric vehicles as they go. So I think this is going to be a big winner, and I see 30% upside, $22, $23 a share if they can just trade at a 12 multiple on $1.80 in earnings. So we like this one a lot.
All right, three ideas to go into the weekend with. Sandy, thanks so much. Appreciate it.
Thanks for having me, Sue.
Sandy Villery with Villery & Company. Coming up, a glimpse at some of the world's more unique and expensive classic cars.
The big guns of car collecting here at Pebble Beach. Coming up, we'll show you the most famous movie car in the world, 007's DB5.
Here's a look at what to watch for next week. On Tuesday, Home Depot reports its earnings, giving investors new information on the health of housing and the consumer. On Wednesday, we'll find out if lower mortgage rates helped increase the sales of existing homes. Also on Wednesday, the Federal Reserve releases the minutes of its last meeting, and that's what to watch for next week. Car lovers rejoice. Some of the rarest and coolest collectibles are on display at America's most prestigious car show. But as with most things, the market for classic cars is changing. Robert Frank kicks the tires in Monterey, California.
It is the Woodstock for wealthy wheelheads. Nearly $400 million worth of cars expected to sell here in Monterey and Pebble Beach this weekend. So far, the classic car market seems to be powering through Wall Street swings and the global slowdown. Collectors say they hunt certain cars for years, and when one comes up for sale, they pounce, regardless of the stock market.
There's an emotional component. I'm a collector. If I really want something, I'll find a way to get it. Not stupidly, but I'll weigh those other factors, but we all find a way ultimately.
So some of those big guys, they say, this is my one chance to get that car, and they'll step up to spend the money to get it.
Now, the most expensive car to sell this week is actually a race between two cars. The first is this 1939 Porsche Type 64. This is the first car to actually wear the Porsche name. It could sell for over $20 million. Now, neck and neck with that is the 1994 McLaren F1. Now, this car retailed for $800,000 back in the mid-1990s. This car today will sell between $21 and $23 million, which is why Jay Leno said his McLaren F1 is the best investment he has ever made.
I bought my McLaren F1 in 1999 for $800,000, and the last offer I got was $17,500,000, and one just sold for $22 million.
Now, the market for big multi-million-dollar Ferraris and Porsches has cooled a bit, but millennial collectors are driving a boom in lower-priced vintage trucks and SUVs and four-wheelers, like this Ford Bronco selling for up to $80,000. And two movie cars are making cameos this weekend. James Bond's silver 1965 DB5, made famous in Goldfinger, sold last night at RM Sotheby's for nearly $6.5 million. Mecum Auctions has the Ferris Bueller Ferrari, actually a replica used in the movie. It's expected to fetch over $200,000. As the great Ferris Bueller once said, "It is so choice. If you have the means, I highly recommend picking one up." For Nightly Business Report, I'm Robert Frank in Monterey, California.
And before we go, here's a look at the day's final numbers from Wall Street. The Dow rallied 306 points. The Nasdaq was up 129, and the S&P 500 added 41. But for the week, the major averages were all lower. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. Have a great weekend. We'll see you right back here on Monday.